Hello, Pfizer MBA 503 students. I received a request from someone to basically put up the lecture on the statement of cash flows. Same lecture I gave in class, but to put it on YouTube. So I'm going to go ahead and do that. And so it's the same lecture I gave on Tuesday. This is a statement of cash flows. It's going to be split into um, three different videos to keep them short. The first one is the format. Second one is going to be kind of the setup of the statement of cash flows. And the final one, I'm going to make the statement of cash flows. Okay, so let's get started here with the format of the statement of cash flows. Okay, the statement of cash flows has three sections. Section 1 is the cash flows from operations. Section 2, and so you have one subtotal for operations. Section 2 is you have cash flows from investing activities. And section 3 is you have cash flows from financing activities. Okay, I'm going to go over the format of each one. Now, each one of these sections has a subtotal. So you have a subtotal for operations right here. You have a subtotal for investing activities right there. And you have a subtotal for financing activities right there. In this video, I'm going to go over the format. In the next two videos, I'm going to do the example. Okay, let's see now. Okay, so operations. This is cash flow that you make. These are cash flows from operating your business. Okay, and it's purely from operations. And in order to do that, we start with net income. So you're going to pull net income from the income statement. So net income goes in operations. That should be an O in the problem. Okay, so anyway, so net income goes in the state operations. You plug it in there. Okay, now the next four rules are what I gave you in the lecture. Is after putting in net income, we're going to have to adjust net income for short-term transactions involving current assets, current liabilities, which had a different effect on net income than on cash. This basically converts your accrual basis net income to cash basis net income. Okay, so the first rule is we're going to compare the increases and decreases in current assets and liabilities. Now, in the case of current assets, if a current asset increases, then you subtract increase in the current asset. So if at the beginning of the year you have current assets of current, let's say accounts receivable of 18,000 and has gone up to 3,000 by the end of the year, that means that you're going to subtract that increase. Next one is for all current assets, by the way, except cash. You don't include cash in this reconciliation. And next one is for current assets. For any current asset that goes down, so if you have a decrease in a current asset, then you're going to add it back. So if you had accounts receivable, let's say inventory. If inventory was 15,000 at the beginning of the year, and it was 12,000 at the end of the year, then you would add back that $3,000 decrease in a current asset. So the rules are, and I emphasize this, for current assets, the change goes in the asset goes in the opposite direction of the adjustment. Very important. So for current assets, always think that the change is in the opposite direction. So if a current asset goes up, you subtract it out. So the change, the increase, is opposite of the adjustment. And then in the case of decreases in current assets, if they go down, you add them back. So the change is the opposite of the adjustment. If current asset goes down, you add it back. The opposite holds true for liabilities, which is always the case in accounting. For liabilities, what we're going to do is we're going to see that the change in any current liability is the same as the adjustment, goes in the same direction. So if accounts payable go up, so let's say you owed 11,000 at the beginning of the year, and at the end of the year you owe 20,000, that $9,000 increase in accounts payable would be added back to the operations section of the statement of cash flows. You add it back in this section right here. Okay. And then opposite here, if there's a decrease in current assets, then you're going to subtract them out. So if accounts payable was 10,000 at the beginning of the year and it went down to 8,000, you would subtract out that decrease in current liability. Okay, so just to review, these are important rules. For current assets, the change is always the opposite of the adjustment. So increase is subtracted, decrease is added. Whereas for current liabilities, any current liability, the change is always the same as the adjustment. So if they go up, you add it back. If they go down, you subtract them out. Okay, now there's only three things left here in the operations section of the statement of cash flows. Okay, the first one is after you start with net income and make the adjustments for current assets and liabilities, then you add back your depreciation expense. Now, depreciation expense is always added back because it's a non-cash expense. If you think about it, if you remember the journal entry for depreciation, it actually comes in a couple of chapters down the road. But when you record depreciation expense, you debit depreciation expense, which drives down net income, and you credit accumulated depreciation, which decreases your net book value. But no cash goes out. So you have an expense here that has decreased net income, but has not resulted in a cash outflow. That's why we're adding back depreciation expense. And the next one, I'll try to explain in the example, but I'll just actually remember it now. If you sell an asset, and if you have a gain, that is, if you sell it more than its value on your balance sheet, book value on your balance sheet, you have a gain. You're going to subtract out that gain. You're going to subtract out that gain. And that's going to be the operations section of the statement of cash flows. If you sell an asset and it's at a loss, so if you sell it for less than its book value on your balance sheet, you're going to add back the loss. And I'll try to explain this as I go through the example. It's plainer there. And basically, we're zeroing out. The gains and losses are part of net income. So we're zeroing out gains and losses on net income. Okay, and so if you start with net income and add back all these adjustments to current assets, current liabilities, your depreciation expense, subtract out your gains on asset sales, and losses on asset sales, you're going to come to cash flows from operations. Okay, cash flows from investing activities. That's the second section. Okay, think of investments as investments, and generally these are long-term investments. It might be short-term investments you can put in here. Some companies put changes in short-term investments here. Others put them in the current asset section or the operations section. So it doesn't matter, but they frequently go here. Anyway, investments are assets. They're long-term assets, generally speaking, that are in sort of the middle of the balance. Section includes, I'm going to put here, includes two things: proceeds from the sale and purchase of long-term assets. Proceeds from the sale of long-term assets, and I'm going to put here, and cash paid for purchases of long-term assets. Okay, so long-term assets are investments. Investments are things, are assets. These are, it could be land, plant, equipment, it could be intangible assets, could be anything. But they're usually long-term assets here. And the activities, what we're going to put in investing activities. Investments are not things that you use to finance your business. Investments are the assets that you buy in order to get your business to grow. Factory, the equipment in the factory, land, the office building, whatever. Okay, so the first activity that goes here are proceeds from sale and from the sale of assets and cash paid for purchase of assets for long-term assets. and cash paid. So you know, you have long-term assets. If you sell them, you make money. If you purchase them, money goes out the door. And the second activity that goes in here is flows from loans made to other entities. This is not money you borrow. This is money from loans you make to other entities. It could be that you invest in the bonds of another company. That would be a loan to another company. This is not money you borrow. That's going to go in the financing section. But loans made to other entities go here. When you make a loan to another company, that's an investment because you get the interest on it. So, and that's an asset too, by the way. But I always separate that out because people always confuse loans made to other companies from money you borrow from other companies like a bank. Okay, so there's two activities that are going to go here: the proceeds from the sale of assets and cash paid for purchases of long-term assets. Okay, so you know they're kind of opposite there. You sell assets, cash comes in, and you purchase assets, cash goes out. And the same thing can be true for flows from loans made to other companies. If you lend money to another company, cash goes out. When they repay you, cash comes back in. And so each of these activities has an equal and opposite inflow and outflow. Proceeds from the sale of long-term assets is a cash inflow. You sell a long-term asset, cash comes in. Okay? And here's the equal and opposite cash outflow. When you purchase a long-term asset, cash goes out. So it's just what I'm saying in number one. Cash comes in when you sell an asset, cash goes out when you purchase an asset. Okay, and for loans, it's when people pay you back. When you've loaned money to other people and they pay you back, that's the inflow. And I'm going to put here receipt of cash loan to others. So if the activity is cash flows from the loans made to others, the inflow is when they pay you back, cash is coming in. The outflow is when you, oh no, I should not have put that there, is cash loaned to others. So cash received after you've made the loan, then that's the cash inflow. And then the outflow is when you actually loan the cash out, cash loaned to others. But this is loans to others. So there are two activities here. One is for non-current assets. That's number one. If you relate that to non-current assets. When you sell an asset, cash comes in. When you purchase an asset, cash goes out. Activity number two here is loans made to others, not cash borrowed from others. So when you make loans to others, the receipt is when they pay you back, and when you the outflow is when you actually make the loan out. You add these things up, and there could be these four things. There should be lines there, but you add these things up, you'll get cash flows from investing activities. The final activities are financing activities. These are activities that you do to fund your business, to finance your business. Okay, so this is the bottom of the balance sheet. The bottom of the balance sheet consists of what? Long-term debt. This is money you borrow, not money you loan, money you borrow to finance your business. And then it also has to do with stock. You finance your business by issuing long-term debt or issuing stock. But there's a cash inflow and cash outflow associated with each one of these things. Okay, here's what it says. This section provides cash flows from one, issuing, buying back stock or paying dividends. Okay, so when you issue stocks, cash comes in. When you buy stock back or pay dividends, which is kind of the same thing, cash goes out. And two is borrowing and repaying debt. This is money you borrow, not loans made to others, money you borrow. I'm getting excited about that because I want to emphasize that. Okay, so for each of these items here, you have the cash inflows. Cash inflows for activity number one. This is really, I could say here, this is activity number one here. And long-term debt is activity number two. Okay, so for activity number one, which is buying issuing stock and buying it back, paying dividends. The inflow is when you sell the stock, when you issue the stock. When you sell stock, cash comes in. The equal and opposite outflow is when you buy it back, or equally when you pay dividends. So, and that makes sense. When you sell anything, cash comes in. When you buy something back, cash goes out. Next one, activity 2, has to do with long-term debt, right there. And long-term debt, when you borrow money from others, when you issue bonds payable, cash comes in. When you repay cash, I'm going to say cash repaid to others from borrowing from them. Okay, so anyway, so to summarize the financing section, you have the sale and repurchase of common stock. Sale, cash comes in, cash inflow, repurchase common stock, cash goes out. Then you have when you borrow. Second activity is borrowing in the long term. When you borrow money and you receive it, the cash that you borrowed, cash comes in. When you repay the loan, not the loan, but you're borrowing your big liability, and cash goes out. So then we'll have those 4 things will give you cash flows from financing. And then finally, the sum of the 3 sections is going to give you the bottom line of the statement of cash flows, which should equal the change in your cash balance on the balance sheet. So anyway, you have cash flows from operations. That's the sum of the first section. Cash flows from investing activities and cash flows from financing activities. The sum of those 3 things will give you your bottom line, and it should equal or be close to the change in cash balance. Okay, in the next video, I will start the example. Thank you, and I will put up this video now and then go on to the next video.